Let's move on to our third method. And our third method is called double declining balance. This method is accelerated. It's accelerated in the way that it's computed. It's meant to write things off really quickly up front and slow down at the end. This is good for things that wear out more quickly in the beginning than it does at the end. Let's bring forward our facts, and I'll give you a formula. Same old, cost of 15, salvage of 3, useful life of 3. I'd like to give you a formula that I think works really well. It's a little bit different than the one in the book. Here you go. My formula says you're going to write off 100% of this cost over 3 years. It's got a 3-year useful life. So you're going to write off 33.33% each year. Since you're doing double declining balance, double that. If you were doing 1 3/4, you would times it by 1 3/4. That's another way. And if you were doing 1 1/2, you times it by 1.5. But this is double declining balance, so we're going to times it by 2, which says you're going to take 66.66% of the amount of this asset's book value, its declining value, each year, and you're going to ignore salvage value. That's different. Up front, but you're going to stop depreciating it when you get to it. How's that for interesting? Let's see how that might look. I'm going to use a little bit different table than I've used in the back to do this with you. So I think it will help you see it better. You ready? Hold on. So let's put our number in. Our first year, our book value is $15,000. And remember, we're going to ignore salvage value up front. And we're going to times that by 66.67%. Look at that. Times 15,000, ignoring salvage by 66.67. What do you get? The answer is $10,000. So for the first year, we'll take $10,000 of depreciation expense. Accumulated depreciation will be $10,000. And what's book value? $15,000 minus accumulated depreciation of 10 is a book value of 5. Wazoo! Look how much we wrote off the first year. Is that accelerated or what? The second year, we take the $5,000 book value that we ended with at the end of the first year and times it by our accelerated rate, 66.67%. Do the math for me. Depending on how you round, you would like to take 3,334. That would take accumulated depreciation to 13,334. But if you recall, we can only go to 12,000. Where did I get that? 15,000 minus 3. So I'm only going to write off 12,000 of this asset. So I have to stop in the second year. I can't take 13,334. I can only take the remaining amount, which is 2,000. That's going to make accumulated depreciation, 10,000 plus 2,000, equal 12,000. And my book value will be 3,000. And there is nothing for the third year. So let's review that. The declining balance takes a percent, which you get by taking the formula 100 by the useful life, turns into percent per year, times inflator of 2, gives you a rate you're going to apply to the book value. The first year, book value is 15,000. It ignores salvage value, but stops when it gets to it. 15,000 times that, 66.67 is 10,000. That'll be our entry. You'll be accumulated to 10 and have 5 left. when you run that through the next year, you're only allowed to take 2,000, so you have to stop, and there's nothing allowed for the third year. The entry would literally be for that first year, depreciation expense 10,000, accumulated depreciation 10,000, first year, our second year 2,000, and our third year nada, because it's depreciated. How does that look on a time chart for 3 years? Depreciation's 10,000. Let's label that for you for the first year, 2,000 for the second, and nothing for the third. Double declining balance is supposed to be used. It's an accelerated rate for things that were out quickly up front. Does that look fast to you? Because it sure does to me. How does a mid-year purchase affect this? It's a right royal pain in the butt, because you have to completely redo our table for mid-year. It still has a cost. We still have 100% we want to write off. Divided by 3, that's equal to 33.3%. We're still using double declining balance. That makes it 66.67%. We're still going to use that, but we need to adjust it for a mid-year purchase. So the first year, year 1, year 2, year 3, we are going to have it for 9 months. We bought it April 1st. Then we'll have a whole year of 12 months, and we'll see where we are on our table. Our table's still going to be book value. We're still going to have a depreciation expense. We're still going to have accumulated depreciation. And then we'll end with a new book value, which will apply that rate to at the end. Starts at 15,000 times 66.67% is still 10,000, but now we need to adjust it for the fact that it's only for 9 months, April through the end of the year. The first year, that's going to give us $7,500. So depreciation expense will be $7,500. Our accumulated amount at the end of the first year is $7,500, and our book value is $15,000 minus $7,500. It's $7,500. The second year, we bring down our book value and times it by 66.67%. We don't need to do 9/12 anymore. It's for a whole year. Do the math, and that equals 5,000. That would take us to accumulated depreciation of 75 plus 5 is 12,500. We're only allowed to go to 12,000, so we know we've taken 500 too much. So we're going to be able to take 4,500 this first year. What will our book value be after that? Well, it should be 7,500 and 4,500 equals 12,000 minus our purchase price of 5,000 equals a book value of 3,000. So we're fully depreciated still in the second year. Nothing left to do. It does change how we're going to take depreciation expense over the life of this asset. The first year, we're going to only take 7,500 because we only have it 75% of the year. The second year, we're able to take 4,500. You could take up to 5,000. That's our limit if you figure it out according to that second line, but we can only take 4,500 of it. And again, nothing allowed in the third year. Let's compare our whole year amounts and see how they look. In straight line, we took 4,000 a year, 4,000 3 different times equals 12,000. Straight line is good matching, and it assumes that the equipment wears out over time. Units of production took 3,000 the first year based on use, 42 the second and third year, and 600 the fourth year. And this assumes equipment wears out through usage. And we allocated it by usage. Declining balance took 10,000 the first year and 2 the second, for a total of $12,000. And it's accelerating, and it's fast. It assumes equipment wears out fast. Does this affect net income? You bet. The more the depreciation expense, the less the net income. So one could say declining balance would save you money on your taxes. But here's a little interesting note. And that is, Internal Revenue Service uses their own method of accounting for depreciation. And their method is fast, encouraged to make employers want to buy equipment. Generally accepted accounting principles uses one of these three methods. You're supposed to select a method that best reflects how you use your assets. If it wears out evenly, use straight line. If it wears out according to use units of production. And if it wears out fast, use double declining balance. Some version of it. Twice, 1.5, 1.75, all of those work. In a nutshell, depreciation is supposed to match the cost of the equipment against the period benefited. It's a matching concept. It does not attempt to measure fair market value of an asset. It does not attempt to capture cash. All it does is write it off against the periods benefited. If you want to know what fair market value is, get an appraisal. Sorry this took so long, but since we did full year and partial year and 3 methods, we needed to let this stretch out a little bit. Thanks a lot for joining me. Talk to you soon. Bye now.